So welcome back to Red Cloud Summer Uranium Conference. I'm David Talbot, Managing Director and Head of Research at Red Cloud Securities. Now we're going to mix things up a little bit right now with our second keynote speaker of the day. I introduce Nicolas Piquard of Horizons ETFs. He's VP Portfolio Manager and Options Strategist. Nick, you had me on your platform. It's only fair you join Red Cloud on ours, so welcome.
Thank you, and happy to be here. You know, investors like to identify in long-term trends, and it's proven to be, ETFs have proven to be a very useful tool to do that. And so what we're going to talk about today is a little bit about thematic ETFs and how you can play the uranium sector using those ETFs.
Perfect. So maybe just a little bit of introduction here. Nick oversees the Horizon suite of commodities ETFs. He co-manages the global lineup of covered call ETFs, and he oversaw the launch of Canada's first uranium ETF as well. Prior to Horizons, he spent about 15 years in institutional derivatives as a trader with Canadian and international brokerage firms. His expertise covers oil and gas, alternative and emerging energy sources, including uranium, lithium, and hydrogen, which are all timely topics these days. So, Nick, we have about 20 minutes scheduled, so perhaps we can get some questions in at the end of your talk. So, viewers, hit that Q&A button on your screen. We'll get to as many questions as we can. So, take it away, Nick.
Thank you. Let's get right into it. You know, as most people know, exchange-traded funds have been a very fast-growing market. It's taken significant market share away from more traditional mutual funds. And we can be proud that, ETFs are kind of a Canadian invention at its heart when TIPS and HIPS first traded on the TSX years ago. But the industry's really grown and specialized, and one of the fastest growing parts of the sector has been thematic ETFs. As you can see from the chart, the thematic part of the market has really exploded in the last few years as investors look to capitalize on specific sectors or ideas that aren't reflected in broad market indices. But when launching a thematic ETF, we think to have several characteristics to be successful. Obviously, first of all, it needs to be a good investment proposition. It also has to fill a need to make life easier for investors in a meaningful way. And finally, it has to have a long-term bullish prospect and capitalize on secular trends. Creating these ETF costs a lot of money, and we want to make sure that the investment case stands the test of time. And alternative energies is, I think, one of those secular trends. It broadly meets all these criteria. The world is facing a big challenge. More and more countries are setting aggressive goals to reduce emissions, and under the new COP26 agreement, many nations will come back and set even more aggressive emission targets going forward. COP26 also points a way forward to reducing carbon emissions using formalization of carbon emission pricing. And we actually have an ETF that does that as well. But businesses are more focused than ever before on ESG factors, and investors are demanding more as well. This is driving change both at the top government level all the way to household consumer choices. And how are we going to fill this large gap? Globally, fossil fuels still account for over 50% of power generation, and we're going to need a lot more nuclear, hydro, wind, and solar if we're going to meet our emission goals. Transportation in the US is 30% of emissions, and electrical vehicles are growing exponentially today and will likely continue in the future as more and more countries are setting aggressive targets to ban the sale of internal combustion engines. But all these EVs are going to need electricity to charge these batteries. Now, uranium has been enjoying a bit of a renaissance in the past year as the global energy crisis makes clear how stable nuclear power is. When we looked at uranium 2 years ago, we were still in the midst of a bear market. But with the shutdown of MacArthur River, Langer Heinrich, and the privatization of Kazatomprom, it really felt like the excess supply that had been plaguing the sector for years was coming to an end. At the same time, increasing concerns over global warming and climate change were leading to potentially much faster demand for zero emission energy. It really became a supply and demand story. And I think one of the big tailwinds for uranium is where we are in the commodity cycle. If you go back and look at the big commodity bull markets of the 70s or in 2000 to 2010, they were driven by inflation and by strong commodity demand by China. Where are we today? Well, today we're back in the inflation of the 1970s. As well, we could see a lot of commodity demand, both because of the energy revolution, but also because countries like India are pretty much where China was 20 years ago. This is the backdrop for a multi-year bull market. Now, what about uranium? So this is a slide showing both the term and spot market for the uranium price. I'd like to point out two things of significance here. The first is how the spot market leads the term market. While most of the utilities will likely trade on the term market, there's always an incentive to buy material on the spot market if it's lower than term. And it's, I think, not too dissimilar from when you're borrowing short to lend long, as the banks do, to make money. But when spot rises above term, as it has recently, then that's what commodity futures call backwardation, and it's a sign of tightening supply. This drives the price higher and has been the cause of previous bull markets in uranium, and we're seeing that today. Uranium price cycles have historically been long due to the long contracts entered by utilities and the long time it takes producers to react with additional supply. So this is a familiar slide for probably a lot of viewers here today, but it really points to the dual dynamic at play here, both from a constrained supply side and increasing demand. Not only is there not enough uranium produced today to satisfy existing demand, with demand only being satisfied by secondary inventories, but demand is being revised higher every year going forward as the life expectancy of existing nuclear fleet is being prolonged by decades, as governments struggle with electricity grids and plants are getting lifetime extensions. But it's not just from the existing nuclear fleet. The world plans to build a lot of new reactors, and a few speakers have already spoken to this, but China plans to spend $450 billion on new nuclear power plants. That's 150 reactors in 15 years. That would add 33% to the existing fleet that we have today. And a lot of these reactors would actually be bigger and consume more uranium. But it's not just China. A lot of other countries, France, the UK, Korea, they're all planning on building new reactors ever since we had the electricity crisis in Europe. And I think John earlier today spoke about Diablo Canyon. I think Diablo Canyon and California show a good summary of the problems the world is facing. Until recently, California wanted to get out of nuclear, and a lot of nuclear power plants in the US were shutting down because of the low natural gas prices that was competing with them. Well, now we see natural gas prices exploding, and in addition, California is struggling with hydroelectricity as well. This week, there was news that Lake Mead, which powers the Hoover Dam, reached an all-time low and is currently operating at a 33% reduced capacity. Hydro in California is going from 15% of their energy mix to 8% due to the climate change. This is really what's driving this change of heart for California politicians. They realize that their only source of baseload power that is zero emission, which is hydro, is quickly not able to keep up with growing demand. And this comes at a time when we're asking more and more from our electricity grid. Not only is electricity demand increasing, but EVs are growing globally. And the big question is, how are we going to fill that gap? Now, European prices, electricity prices, started to spike way before the conflict. And that, people might forget, was driven by low wind generation in the North Sea and struggles with Norway's hydro output as well. So what I find interesting, these dynamics have only gotten more compelling since the start of the Russia-Ukraine conflict. Whereas until now, the main argument in favor of nuclear energy growth was its zero emission credentials. Now with the new conflict, it's national energy security that is front and center in any government's mind. So to me, this is the mega trend potential of uranium when it comes to electricity generation. Land prices are only getting more expensive. People don't want to put more wind turbines in their backyard. Nuclear really represents the smallest land use and the highest power density. Going forward, as we need more and more electricity, nuclear makes more and more sense to be part of that mix. And there's a potentially bright future ahead for next generation technology as well, with small modular reactors. And a lot of the leading countries, the US, Canada, France, the UK, they've all announced plans to launch new SMR projects. And we already have existing SMR projects in Russia and China. So a little bit about Hurrah, which is the only Canadian listed uranium mining ETF. It's the first pure play uranium ETF in the world, with companies focused exclusively on uranium mining. It's been very successful. We've been very happy with its performance, and it's attracted a lot of attention, and it's also giving us the idea to launch several more alternative energy ETFs, such as lithium, hydrogen, and copper. But this ETF, Hurrah, is a passive ETF. It has a 20% holding currently in physical uranium physical uranium through holding companies, as well as 40% in the large cap stocks that are producing uranium, such as Kazatomprom and Cameco, which are both pure plays. And finally, 40% in junior miners. It's geographically diversified with exposure to listings in Canada and the US, but also Australia and the UK, which is sometimes markets that investors don't necessarily have access to. So when I spoke earlier about thematic ETFs, I spoke of 3 keys to success. And I think that Hurrah and the uranium sector fit those well. The strong supply-demand imbalance in the sector is an attractive investment opportunity. The ETF makes life easier by giving access to an internationally diversified portfolio of uranium producers and junior miners, as well as exposure to the physical commodity, all in one easy to buy stock. And finally, the long-term aspect of the secular trend. The uranium story has a multi-decade growth potential as we struggle with energy security and lowering carbon emissions. And I think if we look at the situation in the world today, this is a really interesting and compelling buying opportunity. We've seen a pretty large pullback in a lot of these uranium shares, even more so than the underlying commodity. And this has been driven, of course, by the tightening financial conditions. But this does not take into account the secular trend that is developing behind. The fundamentals have not changed. And for anybody who's not involved in the sector, HURA does really provide a one-click buy to a diversified portfolio of this uranium sector. I'd like to leave it with a few disclaimer slides for you to take a look at. And then finally, please reach out to us. We'd love to hear about what you think of our HURA ETF, as well as any other ETFs that we might have, and as well, reach out, ask any questions you may have, and we're happy to respond via social media or email and telephone. And thank you very much.